What's up, guys? I'm nobody special, and I'm very happy today because back with me is Miss Melody Wright and John Comiskey. And just a couple of weeks ago, the three of us got together and we did this video about these FHA loan workouts and some of the work that John and Melody were doing to draw attention to this outright fraud and grift that was going on in the housing market. And there has been a big development on that front. And as soon as I saw that earlier this week, I got right on the phone with Melody and John. I was actually in a water park with my girls at the time when I saw that. And so I was splitting my attention and putting all kinds of typos in my messages while trying to set up this interview. But John and Melody were kind enough to join us again to talk about what's going on. Now, before we do that, I just want to plug John and Melody's work. Melody is the author of the M3 Melody report on Substack. She's also M3 Melody on Twitter and has a YouTube channel. I'm going to put links to all that good stuff down below in the comments, as well as links to John's Substack, which is called Reverse Engineering Finance. And I'll put a link to John's Twitter feed as well. You two have both done fantastic work on this subject. So real quick, we're going to start with Melody. Melody, maybe for people who didn't see that original video that we did a few weeks ago, I'll also put a link to that down below. Could you do a quick summary of what the issue was that we talked about in that video before we get on to the new developments?
Sure. And I'll even go a little bit further back, Jack, to say that, you and I have talked about this on another video, but in June of 2023, we started to see serious delinquency in FHA. And that was something that I'd been calling out. Now, as we entered into an election year, it became really important not to let that delinquency kind of run off the rails. And what happened during COVID was, back after the GFC, there were workouts, there were loan modifications, but they had very strict requirements. The borrowers had to send in a lot of financials. The servicers fully underwrote the loan. Fast forward to COVID, a lot of times you didn't have to send in anything. In fact, you would just do nothing. You wouldn't even have to call your servicer, and a modification might arrive in the mail. So the programs were very, very generous, far more generous than anything we saw during the GFC. For instance, you could put a full 18 months of missed payments at the back of the loan. And so, just in time to keep things kind of moderate for 2024 as election politicking got started, they, announced the extensions of these programs as well as very generous workouts where you could ultimately become delinquent, do that, take those payments, put it back at the loan. If you became delinquent again, you could go do it all over again to the tune of 30% of the unpaid principal balance. And so this went on all last year. I saw it in client books just over and over again. You would just see recovery, partial claim, recovery, partial claim. And it was working like magic, keeping people out of foreclosure. Kind of right before the Biden administration left office, they extended this program yet again. Really didn't put any type of guardrails on it. And so, this is what, entered John and some of his sleuthing, and I'll let him talk about that. But we could see that this program, although surely intended to help struggling homeowners who, just lost their job or had a reduction in income or something like that, what we really started to see is that it was being strategically used by investors and fraudsters. Honestly, there was a Wall Street Journal article that came out talking about this program. That's when you reached out to me. Jack was like, whoa. And we kind of, everything converged together that this is something we'd been talking about, but the implications were great, such that only 9 foreclosures happened last year. And what we understand is this is propping up home prices. So, Jack, does that summarize it?
Very well and very succinctly. And guys, I just want to reiterate, I got a lot of really good feedback about that video we did a few weeks ago about both of you guys. Melody, both your description of the problems, and John, the anecdotes, or as anecdata, as I like to call it, the examples that you showed up of these people who buying these houses, not just middle-class homes, like really nice houses, and just never making payments. And nobody was losing their homes. And look, I don't like to see people lose their homes, but I also don't like to see entire generations priced out of the housing market, which was really the problem we were kind of taking on in that video. And you two have been at the forefront of the criticism of this program. And Danielle DiMartino Booth has also been very vocal with her open letter to the Treasury Secretary and to Congress to address this problem. So once again, guys, I just want to reiterate, to really understand the scope of the fraud that's been happening in the housing market, go back and check out that video. Again, the link is down below. Now, let's talk about this recent development here, Melody, because while I was at the water park with the kids, I saw your tweet about this update. Tell us about the update and what it means for the housing market.
Well, it was shocking in a good way because, Jack, we'd seen them nibbling around the edges of some of these programs, like shutting them down to, non-permanent residents, shutting down the VA program, which John can talk to more. That was very shocking because really they don't have these same types of workouts. But they weren't going after what I would call a big kahuna, which was FHA. So when suddenly out of nowhere, and I don't even know what day that was now because it's so surreal, we get an announcement that not only are they stopping the program early, so now stopping these really just very loose requirements at the end of September of this year. They're also putting in the guardrail of now borrowers are limited to only one of these workouts every 2 years. There had been a proposed rule out there that they could only do it every 18 months, but they got even more conservative, which I wasn't expecting. And so a lot of folks on X Twitter were kind of saying, well, why didn't they stop it immediately? Personally, I remember when we rolled out HAMP back during the day. I remember the stress at the servicers, what that did. I think I've told you the story about the guy over loss mitigation getting threatened by my CEO. He threatened to kill him if he didn't release HAMP on time. This is how stressed everybody is. So these are huge, massive machines, and they're also liquidity machines that back up the mortgage-backed security market. Any change that you make is going to cause a hiccup. And so, they couldn't just shut this down overnight or it would have been chaos. Now, John will probably point out that they were about to do it. And so these servicers probably could have figured it out. But I think I would be more concerned about the MBS market. And that's something that I'm going to be watching very closely because this product, everybody thinks is ultra safe in terms of these mortgage-backed securities because they're backed by the full, by the government completely. However, and these MBS are used all over the world to pledge for collateral to go out and make other risky bets, Jack. And so suddenly, and I've had people calling me from the old days talking about this. So suddenly, if people think, I don't know that I want to own that because the language in the letter was very interesting. It was, this has put our insurance fund at risk. I think they said something like not prudent. I can't even remember exactly the words, but any inkling that the MBS market's like, I don't know about these and I've started to see pricing degrade already. That could be unrelated. That's just something we're going to watch. So you have to be careful with these things, but it was shocking news that they were really putting the guardrails in place much sooner than anticipated, and also limiting and expanding the amount of time before you could come back to the till.
And this is the update that caught my attention, Melody, that made me break decorum and violate the cell phone rule at the water park when I saw this one. Melody wrote, I believe this was on Tuesday, I am in complete good shock and still digesting. You tagged Danielle DiMartino Booth, who has also been drawing a lot of attention to this, as well as John. And then you put a screenshot here. Now, the screenshot that Melody is including is from this document that the Department of Housing and Urban Development put out. This is Mortgage Letter 2025-12. And here's some of the language that you described, Melody, here. FHA Home Affordable Modification Program, or the HAMP that you described, and the currently published standard pre-foreclosure sales and standard deed in lieu of foreclosure will remain suspended through September 30th, 2025. Now, that was originally supposed to be April of 2026. It was like Biden's like parting shot as he exited office, as he extended this program out to 2026. And they're talking about how COVID-19 recovery loss mitigation options extended through and will expire on September 30th. So months ahead of schedule. These programs that allow people to essentially just not pay their mortgage for years on end, as John very well documented and described in our last video, they're going away in September. And now here's some of the language that you were talking about, Melody, as well. They're talking about how, let me find the right sentence. In January 2025, HUD published a new permanent set of loss mitigation tools intended to maintain streamlined processes to minimize burdens on mortgagees, provide sustainable, there's that word, sustainable loss mitigation solutions to borrowers to address delinquency, prevent foreclosure, and here's where it gets interesting, and mitigate risks to the Mutual Mortgage Insurance Fund, or the MMIF. That's kind of the thing there, right? We were talking about in our prior videos how there is this insurance fund that's out there to backstop these programs, and the abuse was getting a little rampant to the point where we were going to start tapping into that insurance fund. And well, that could eventually potentially leave the taxpayers on the hook. And so HUD is addressing these issues. You know, they're saying upon further review of the policies, HUD has determined additional changes are necessary to protect the insurance fund. HUD continues to see increased default rates on COVID-19 recovery options, something John has done a great job documenting, as well as the use of these recovery options in a manner inconsistent with prudent management of the MMIF. That's borderline a little bit of alarmist language there, John, isn't it? Like when they're talking about prudent management of the MMIF. Tell us a little bit about maybe what was the thinking going on at HUD when they decided to put that language in there.
Well, I mean, look, HUD is ultimately their mortgage insurance fund, right? And while, I mean, there's a lot of money in the mortgage or in the mutual insurance fund, an amount of money that, like on the surface, isn't really threatened by the volume of likely loss that they will end up eating on some of these loans, but they still, like any of those losses, translate to higher mortgage insurance premiums on other FHA borrowers. And of course, there's always tail risk, right? Like the real question here is, okay, so these losses aren't, terrifically material or shouldn't be terrifically material to the FHA, but that assumes that home prices don't, face a very, very, significant pullback. And that's the wild card in this, right? Is what type of a catalyst will the increased foreclosure activity and the increased loss mit dispositions for selling ultimately have. And there's a variety of opinions out there on this. And to be completely honest, I don't know, but there is a risk. There's a risk there. And the current FHA loss mit policies, the ones that will sunset in October, they're just, on all of these loans, they increase the FHA's risk, right? Because to the extent the borrower has equity, they convert, borrower equity into FHA exposure for every one of these partial claims or every one of these mods that adds the arrears, the mispayment to the mod principal because they've exhausted their partial claim pot. All of these things just, extend and increase the FHA and the insurance fund's liability, which even if it doesn't materialize as a threat to taxpayers having to bail out, it's absolutely material on FHA borrowers, the ones who are responsibly meeting their payments, who have to incur a higher cost of mortgage insurance. So it's brutally unfair to them to have to cover those losses.
So yeah, you're right when you're talking about you're converting borrower equity into FHA risk, right? Because all right, you're not making these payments, so the payments just become a second lien on the property.
That's right.
Backed up by the value of the home. Well, what happens if the home declines in value? Well, then that second lien is now at risk and the FHA is holding the bag. Yep. If the FHA is holding the bag, the next kid that wants to buy a house, and I say kid, a young adult, wants to buy a house with an FHA loan, well, he's going to have less favorable loan terms because the FHA is going to transfer that loss to the next guy in line. So you're right. It's really not fair to the next generation of borrowers.
Yeah.
Melody, you mentioned something as well. You talked about limiting the number of workouts, or the 24-month limitation. Could you describe what that means? Like, what was it? And then what does the new limitation mean?
Well, there wasn't a limit. The limit was that you could go for 30% of your unpaid principal balance. And that, if it was a higher balance loan, that's a lot of money. And so, and I see it in my client books. Loans originated last year, 2024. Maybe they paid the first couple of months. They haven't paid. They got one of these workouts. They don't pay again. They come back, and it was just going over and over and over again. And so there's no skin in the game in that. I mean, it's just, and this is, I think, where people get there's been a lot of talk after the GFC about, lots of people didn't apply for workouts because the process was burdensome, but I managed default. And I can tell you, people need to have skin in the game. If they don't, they're going to walk away. They're going to strategically default. And so there was no skin in the game, and folks just called in, and it was honestly very similar to what happened to student loans before they became the problems that we're starting to see right now. Is you would just call into the servicer and they say, you need a forbearance? No problem. You need this? No problem. And so that's really what was happening. And so I can tell you that once folks truly understand the implications of this, you're going to hear this door just slamming shut for people, because they've just been so used to calling in and getting some sort of workout. And I think I've told you and shared last time, I'm working with borrowers who have actually been extending and pretending since 2005 and 7, through what those workouts back then, and then now these new workouts. And so honestly, with that, just limiting it for 2 years, people are like, well, it's only 2 years. I'm like, you guys don't understand. These borrowers won't have 3 months. I mean, a lot of them won't have 3 months. And the ones that, it was for fraud and they aren't getting rent because they can't find a tenant or things like, these are the folks that are immediately going to be distressed.
Now, John, I think you showed us some pretty good examples in the last video we did on this subject. Again, I'll plug that one down below. You were showing like some guys who made no payments. 6 months go by, workout, make no payments, another 6 months, another workout, another 6 months, another workout, rinse, repeat over and over, never making any payments.
Yep.
So they can do that once over the course of 2 years now, limited by 30% of the principal balance. And that's it. Is that accurate?
Yeah. So I guess, from here, nothing changes for the next 5.5 months, right? It's the same nonsense that's been going on. So, depending on how they're timed with respect to their partial claim, if they just got one and they get one again in, say, September, right before the tightening, then they'll have, 3-4 months on that before they'll get their final. But after October 1st, all the FHA borrowers will effectively get one more shot at loss mitigation. And then that one shot, that's it for the next 24 months. But importantly, it's not just that, okay, they're getting one final shot. They have to, in order to get that shot, they're going to have to make trial payments. They're going to have to do 3 trial payments for, whatever the workout option is. Maybe it reduces the payment, maybe it does not. And if they fail that trial payment, then they're not even going to get that shot, and they're going to go down loss mit disposition, or the servicer, while the servicer is pursuing foreclosure on the borrower. So that final loss mit option after October 1st, 2025, they're going to have to start paying immediately, or they're going to be, looking at a forced sale or a foreclosure.
And you pointed out in the last video, some of these guys were doing these loan workouts, and after they came out of the workout, their payment was actually higher than going into it.
Yeah.
So if they weren't making the lower payment, what makes you think they're going to suddenly start making a higher payment?
Yeah, it's funny. Melanie said earlier that they were limited by the 30%, that's the cap. And that's true on the partial claims. But with the extend and pretend mods, they keep adding the arrearages, which increases the FHA risk, ad infinitum until the tightening of the loss mitt procedures occurred. And notably in the new FHA, the permanent procedures, modifications that raise the payment are not prohibited. In fact, they're required to be offered, but of course that's mitigated by the fact that the borrower has to prove immediately that they can make it. Are there many practical circumstances where that makes sense? No, not really. Only in cases of the borrower was terrifically gaming the system, could have been making it the whole time, and the modification raises it so they don't have to make a lump sum, but they can make the increased payment. There'll be a few of those cases, I'm sure. Some of those will shake out. But for any borrower that's in genuine distress, a modification that raises the payment makes zero sense from a loss mitigation perspective.
Or that reduces it by $100, right, John? I mean, and that's something we see right now with the 40-year mods is they aren't doing, and even other programs like USDA, they're, you maybe can reduce the payment by $40 to $50, and then what'll happen to the servicer is they take a big loss on that. And so they don't really want to do that, but they have to. So, these 40-year mods don't make sense for almost anybody that I've ever seen, to be honest.
Now, John, you put out a tweet recently. I wanted to bring this one up here because you're using some pretty strong language in this. And I just wanted to maybe give you guys both a little opportunity to elaborate on this as my cat claws mercilessly at my leg and I try not to break my concentration here. What needs to stop immediately is the endless and repeated standalone FHA partial claims and loan mods. The payment supplementals served a purpose, temporary payment relief in a high rate environment. Shutting it down and keeping combo mods and partial claims in an FHA is an FHA gift to mortgage-backed securities investors. So we're drifting into the bond market here, right? Payments not being made. So this was kind of a bailout of the bond market. And now you're saying shutting down means no payment relief, loss mitigation options in a high rate environment. Rates are higher than when these mortgages were taken out now. And a return to Old Testament loss mitigation, for better or worse. All right. So you got my attention there with the Old Testament stuff.
Yeah.
Describe what that looks like.
Sure. And let me just briefly describe what the payment supplement is. And the language in the new mortgagee letter has placed it under review, but for now it remains a part of the FHA waterfall and it's in place now, and it's an option now, and it will be an option in October, unless the FHA comes back with a subsequent letter. And what that does is that uses partial claim money to temporarily, for up to 3 years, reduce the mortgage payment by 25%, which is meaningful payment reduction for the most part. So it gives the borrower some relief. But what it does is because it uses the partial claim money, it doesn't touch the interest rate on the loan. And that's what's important, right? Because if the note is at 4% and prevailing rates are, 6.5%, jacking the rate by 2.5 points makes it almost impossible to get payment relief, even if you throw a bunch of partial claim money at it with a traditional modification. So that's the itch that these payment supplements scratch in order to give borrowers who are genuinely struggling a chance to get some payment relief. If they go away, then the borrower has nothing in a high rate. If you have a 4% note and you need a payment reduction, it's very, very difficult to accomplish that, even if you're using all of your partial claim pot, if you have it all available, which puts the borrower and the FHA at significant disadvantage. But who profits in that situation? The MBS investor who was, having had a 4% MBS, had their capital in a 4% bearing MBS, and now gets their capital back and can reinvest it at 6.5 or whatever market is. So they're the ones who would benefit if they just cancel that. But what I mean by loss mitt, Old Testament loss mitt is, look, if there's no option to reduce your payment, then Old Testament loss mitt is pay or you're gonna be forced to sell or be foreclosed on. And in a high rate environment, that's what faces that's what faces the VA, the veterans right now. There is nothing with the cancellation of VASP in 2 weeks. Veterans will have essentially no option if they got their loan back, when rates were beneath 4.5%, 5%. So they'll have no option. It's Old Testament lost mitt for the VA right now. Congress has talked about trying to get something together, but that's going to take a year to implement. There's just that stuff doesn't happen quickly. And if the FHA gets rid of payment supplement, then it'll be the same boat there too, which is basically you're going to make your payment or you're going to be foreclosed on.
Now, Melody, you lived through Old Testament loss mitigation. You had a front row seat for that, didn't you?
During the GFC. Yes.
Describe that a little bit, because I think that's what we're facing, right? Maybe within a few months of September, this is going to start happening.
Yeah. So right now, if you look at Black Knight reporting, we have about 211,000 foreclosures out there. At GMAC, I was managing 65,000 in 2012, 2013. So, and that's what I think, again, people just misunderstand the last crisis. They always think it ended in 2008 for mortgage. It went on for much, much longer. And so what that looked like, now everybody got involved. And likely that'll happen to some extent as well. Your certain AGs or attorney generals will come in. They might do things like foreclosure moratoriums. At the state and local level, they might try to do something. That's, kind of what happened last time, as well, as you had regulators come in and make, accusations of improper processing, which also put a slowdown to everything while you were offering these loan modifications. But I can just tell you that, when you are managing that much distress, it is, that's obviously one of the reasons that we saw such an impact to home prices last time is, you were having these foreclosure sales and it was not an appreciating environment or a home price appreciation environment. And so, essentially, you were always upside down on these. These things were the banks didn't want them, are the non-banks. And so they would let them go at auction at really reduced prices. And that's when, of course, Wall Street walked in to these big auctions and started buying these houses for pennies on the dollar.
John, are we looking at lower home prices here in the near future? That's been like the pie in the sky that's always been just over the horizon. When are home prices going to come down? I get this question all the time on my channel from young viewers, doing everything right, showing up 9 to 5 and saving their money, keeping their credit good, but homes just keep staying out of reach. Is this it? Is this going to be relief for them finally?
So I defer to folks with more broad-based housing expertise on what the actual impact will be, but I can talk to that this will push in that direction. I think it will be fairly significantly, but it'll push somewhat. And how much it pushes remains to be seen. But I know, in FHA and in VA land over the last 4 years, there has been no supply of housing coming from this channel, which there typically is. And there will be supply coming from this channel starting this year, right? Early this year, like effectively soon with VA, as veterans contemplate having no option. And the ones that have equity right now, it behooves them to sell as quickly as they can. Particularly if you think this is going to have a strong impact. But yeah, this is definitely pushing in that direction, Jack.
Yep.
Okay, so Melody, I'm gonna blindside you with this one a little bit. I'm gonna put you on the spot here. Quantity, the terms John just described there, right? Because we've got a very illiquid housing market right now. I don't have the numbers in front of me, so if you don't have the numbers in front of you, no big deal. I'm just kind of spitballing here. But we've got very few home sales going on, and as John just mentioned, very little supply coming from this typical channel, FHA foreclosures. Now, you watch this very quickly. You look at very closely. You look at the delinquency numbers. It's not going to take a lot of new supply in a current state of liquidity to move price. So, in your opinion, based on the numbers that you see, is this going to be enough supply to finally take those home prices lower?
It's going to be one driver. And honestly, Jack, it's not even the most significant one in my opinion. We're seeing inventory fly onto the market at paces that are, far faster than the average at this time of year. And so I think, honestly, for this year, one of the biggest stories is going to be the wobbliness in the stock market. I think that has a lot to do with what you're starting to see because we have more housing out there per capita than we've ever had. We have 15 million vacant homes, 3 million seasonal homes. In addition to that, short-term rental gone wild. And as we're seeing this trouble in the stock market, people are getting nervous. And so boomers particularly are starting to let go of their second, third, and fourth homes. And a big story I'm hearing about from all over the country are long-term rental. Those that are holding homes to do long-term rental are getting out because of those increases in property taxes and insurance. I have a big California client. They just had to advance out a ton of money for taxes. And I saw those escrow notices going out and they are scary, Jack. Increases of $600 in your payment. People just simply cannot afford that. And so honestly, I think most of the inventory we're going to get is going to be probably from our investor class this year. While you are starting to see folks on the lower end who ran out of their benefits, you are definitely see them come to market. And then, the people that John and I aren't talking about, the really responsible ones are listing their homes and selling them because they don't want that foreclosure on their record. And I'm seeing that in client books right now. But I think that ultimately these things will start trickling onto market. And then by the end of the year into the spring of next year, that will be a bigger driver next year. But we've got plenty of drivers this year, Jack, in terms of inventory. And there's only a handful of places across this country that don't have enough inventory out there. Is it mispriced? 100%, but there is plenty of inventory.
You touched a lot of bases there. I mean, you got into property taxes, stock market. Now, our friend Travis has done a pretty good job documenting the property tax issue with Mitch over at Real Estate Mindset. So yeah, those are adding to the whole carrying cost of these properties. Absolutely. Now, on top of that, you also touched on to use the technical term, the wobbliness in the stock market. I think we need a wobbliness indicator. Maybe we'll come up with that. Put a patent on that name, copyright it. But really, the wobbliness in the stock market has been symptomatic of the chaos in the bond market that really scared a lot of people last week. And John, you kind of touched on how this program was, by extension, a bailout to MBS investors. Now, hopefully, the trade war hysteria is behind us by September. But we've got problems in the U.S. Treasury market with basis trades unwinding and the yen carry trade unwinding. We've got problems in junk debt. The market for junk bonds is frozen like the housing market is now. Now we're about to add MBS to that. So what does this look like in the banking system, in the bond market, if we start to have problems in the MBS market on top of that? Is that maybe driving the delay to September, as we don't want to add mortgage-backed security issues to everything else that's happening in the bond market here?
I mean, I sort of doubt it. I think it's more that the MBS is being MBS is impacted more by the volatility in the bond markets, right? I mean, that's what jacks the spread on MBS, and it's certainly, I mean, there's a Fed component to it too. I think as the MBS market digests the fact that the Fed is unlikely to buy MBS again for the foreseeable future, maybe ever, because even when QT stops, they're going to take the prepayments and the principal pay down that they regularly receive, and they'll reinvest it in treasuries, not into MBS. So I think, that's spiking, that's helping to spike the spread and keep that high. But I don't know. I don't think that there's going to be an issue with respect to MBS as collateral, unless like the GSEs leave conservatorship or something of that nature, which would impact, that would impact that. But so long as they have an effective explicit government guarantee, I think that they'll be okay as collateral in funding markets and whatnot. But certainly the relationship going the other way is happening. I just don't know if that entered into the FHA's calculus for pulling this in.
So it sounds like, okay, it might stress the MBS market a little bit, but we're not looking at, where nobody wants to be holding this stuff because the music is slowing situation like we had in 2008,
Yeah.
not to that level.
Yeah, I mean, it's all about that explicit government guarantee. I mean, if you're an MBS investor, you're going to get paid on time, on schedule. Like that's going to happen in today's environment, so long as it's, Ginnie Mae or agency MBS, and it's not private held or private MBS, which is a different animal. I mean, the real risk is more towards the servicers and holders of the servicing rights, because they're going to have to be the ones who are, paying that capital cost to cover the borrower's mortgage payments, since the FHA is not going to be doing it, replenishing them every 4 or 5 months with partial claims. When loss mitt goes protracted, they're going to be the ones who are in pain.
Melody, you seem like you're chomping at the bit, like you wanted at this one.
Well, I think so. This is a very complicated and connected market that is, if you didn't live through what happened before, you could look at this and say, no, there's no risk to the MBS market. But in reality, understanding how this stuff is rehypothecated on the back end, understanding how these liquidity kind of shortages occur around, it's one big organism, I guess I would say, and it's completely predicated on the con. And what I mean by that is confidence. And so to John's point, that these are, backed by the government, the investors are going to be made whole. Okay, that's the agreement. But we're in a situation right now where we have a very volatile administration that's making that. Personally, I would never put the kind of language they put into this memo, because it is about confidence. And when I've talked to old traders from that were with me back then and watched what happened in the bond markets back then, this is concerning to them, because it's about appetite, and it's also about will there be any delays in when I'm paid, or will the value of there's so many things that could happen. But to John's point, the biggest if it were me and I was the one that made this decision, the thing I'd be most worried about would be liquidity at the servicers, because, and this is something people probably aren't thinking about, at the same time I've heard that the Ginnie Mae staff has been cut, cut at some of these other agencies, meaning delays in refunding things like the partial claim, delays in refunding full claims. And so that backing's awesome. It's great to have insurance, right, Jack? What about those folks that had insurance during Helene or the fires and they still haven't gotten paid? And that's kind of what you're going to see here, especially as the distress starts to accelerate. And those servicers got a real break with that payment supplement, because, as John was saying, they didn't have to advance that money. Pretty soon, they're going to be advancing out more money than they have coming in. And I'm already seeing that with smaller clients. And so it can ripple through the system and hit places that people are completely unsuspecting if the appetite on the upfront changes just a tiny bit. And we're already seeing, as John was talking about, spreads widen out. And so the Fed, unless they come in and buy those mortgage-backed securities, yes, I think appetite might not be as great as it has been. And we're already seeing people pull back from the MBS market. We can't exactly be sure why right now, but it's already happening. So, I agree with everything John said, but I would say that this stuff is connected in ways that most people don't understand until the whole thing breaks down.
Yeah, agree. And one other point that I would bring up, generally speaking, if we're going to reduce trade deficit, then that means that there's less dollars that are flowing out to the rest of the world, right? Which means less dollars to come back into U.S. financial assets, one of which is MBS, right? So, reduced demand for MBS just in general, because they have less places that they need to go stick dollars from their trade surplus. And that'll be an impact from that to some degree as well. Right. Which again means higher rates, and on the affordability, if rates are going to have to stay higher due to other reasons, then from an affordability perspective, something else has to give. And there's really only one other thing to give.
And for those who are wondering what that is, it's price, right? I mean, that's what we're talking about.
And can I just mention something real quick? So again, talking about that, the machine has to keep moving without any interruption. I mean, and that is so important. And so why people buy Ginny, guys, is you get more upfront juice, okay, and what's called your gain on sale, okay. And suddenly, once these servicers get the memo and others get the memo, everybody's going to get the memo that these things aren't exactly what we think. Sure, we're going to get paid, but most people don't understand. So let's take the investors are kind of separate, although these guys are all mixed up. They're investors and holders, and I mean it's very complicated. But once the memo is that, yeah, I get a little juice on the upfront, but the expense on the back end far outweighs that, then again, you're going to have this issue where appetite is less in the MBS market. Once that just stops the machine, it's kind of like throwing a wrench into something, right? It just stops it a little bit. Once that little stop happens, because there's just so much dependency, you could cause these back end effects in the MBS market. So hopefully that made a little bit of sense.
Yeah. And, when you're talking about a complex machine like that with so many moving parts, it's not as simple as, well, the traditional relationship. If this goes up, this goes down.
Right.
You're talking about second and third order knock-on effects where it's not so cut and dry what's going to happen if this does this, that does this, because there's other variables that we can't even see here. And nobody can do this kind of math in their head. We can come up with educated guesses, but really you don't know until you see it. And it's those unforeseen consequences of things like the language is about the prudence and sustainability of the MMIF, right? You got to be careful with that language. If you cause a little dent into the confidence that money will always be there to pay you back, that lowers the demand just a little bit. You could have a big effect on price there. So it sounds like one big I don't know. And I know people are looking for clarity and certainty, but certainty is hard to come by these days, especially with things like John pointed out with the trade war and just the effect of fewer dollars looking for a place to be parked because of declines in global trade. We don't know the effect that's going to have. We've never seen it.
Yeah, I think what is certain is that there's going to be a couple 100,000 between FHA and VA homes that are either going to be dispositioned, like forced sale or foreclosure, and that's going to happen in relatively rapid effect starting this year, right? Like there's been a buildup of these things that have been delayed because of the various moratoriums or because of the FHA nonsense. There's water that's built up behind the dam, and that's going to release. Folks can make their own opinion as to exactly how much impact, that couple 100,000, all coming in a relatively short time frame will have. But that is going to happen absent some, subsequent government policy, which I don't think will, but I mean, you never know.
Well, I just want to say thank you very much to both of you guys, because you really were in the front lines on this fight, we'll say. I mean, you guys have been leading the charge for a healthier, more sustainable housing market and more equitable and fair housing market to younger generations. And, Danielle DiMartino Booth really helped to amplify that message as well. And you guys have moved policy, it looks like. So excellent work, you two. You really did have an effect here. Thank you for doing that. And real quick, I just want to plug your channels, because if you guys want to get this information directly, not have to use me as a middleman, you can get it. Melody, tell us about your Substack.
Sure. So this is where I write, to really give you honestly, sign up for the free version, even if you can't pay, because I put a lot of data in the upfront to kind of teach you about this very complicated market, what the drivers are, and so you can understand what's happening around you. So encourage everybody to check that out.
You're also on X and on
Yes.
YouTube as well.
Yes, I am. Thank you,
And I'm going
Jack.
to put links to those down below. I highly recommend all of that. And John, you have a Substack as well. Tell me about reverse engineering finance.
Yeah, it's actually kind of split now between focusing on the mortgage data. Like Melody, I do a lot of free posts and a lot of paywall posts where there's a lot of content above the paywall, and then I also release a lot of data for paying subscribers, including near real time looks. Like as soon as the MBS data for the previous month drops, the next day in your inbox, you're going to get updated stats on FHA delinquencies and breaking down the portfolio in different ways, so you can really understand what parts of the portfolio are troubled, which ones are not, and how they're performing. And then I also write on such interesting topics as what the Treasury is going to spend, and when the Treasury is going to run out of money if they can't reach a deal on the debt ceiling. So you get both global money plumbing and mortgage data all in one Substack.
And I tell you, both of your Substacks, Google gets a workout every time you guys put out an article, because there's always 10 or 15 things that I've just never heard of before that I end up having to look that up just to understand what it is you're teaching us. So it's a very good tool for teaching me just how much I don't know when I read your articles. So excellent work. Highly recommend all of those guys. Again, the links are down below to all that stuff. Thank you for what you've done. I really do think you guys have done a public service by bringing this issue to the forefront. It's now causing movement on policy. So a job well done. Keep up the good work. And everybody else, until next time, live small and dream big.
Thank you so much.